About the same size. The soul of Nvidia, the intersection of computer graphics, physics, artificial intelligence. It all came to bear at this moment. The name of that project, General Robotics 003. I know, super good. Super good.
Coming up in today's review, stocks finish higher, Nvidia's new AI chips, is this an AI bubble or not, Apple trying to catch up, the changing bond market, oil breaking out again, and the Bitcoin flash crash. And welcome back everybody to the daily review. Apologies I couldn't make it in yesterday. I was finishing up some coding for my latest indicators that I'll tell you more about this week, but just looking at the market today was quite a green day across the board. With most sectors finishing higher, apart from Nvidia, there was a bit of weakness in some other semiconductor stocks. Saw a pop up in cyclicals, and energy, oil and gas continuing to perform well here. There we are in the S&P 500, still in this parabolic grind higher, just consolidating below 5,200, and it's looking green across the board. We've even got bond yields in oil uptrending in all time frames, volatility downtrending. Only just got a little bit of weakness up the front in semis and Bitcoin, but everything else is pretty much moving up here. And I'd just like to introduce you today to my newest custom indicator called sector analysis, and that gives us a good visualization of the 11 S&P main sectors out there, as represented by the ETFs. And basically this indicator here shows the rolling 1 year performance for each of these 11 sectors. So we can see over the last year, communications, which holds stocks like Meta, Alphabet, Disney, Netflix, and technology are the two best performing sectors, up 47% and 45% over the last year. And the worst performing sectors over the last year, utilities, staples, and real estate. And this indicator illustrates clearly the type of market we're in. We can see growth sectors have been outperforming for a while, and defensive sectors like healthcare, staples, and utilities have been underperforming for a while. And just zooming in on the black line, which represents energy, and that's color-coded black because most of the sector owns oil stocks, and we can see energy's really climbed up these last couple of weeks and catching up with the growth sectors. And so why this indicator is good is because a lot of people just look at the S&P and NASDAQ and don't realize how wildly different the performances of sectors can be inside the market. And just to illustrate that point, looking back over the last couple of years, for example in 2022, energy was the only sector to finish higher, up a huge 58% for the year. Every other sector finished lower, led by REITs finishing down 39% of the year. And so that's a huge, almost 100% performance difference between the winning sector and losing sector. And so the trade in 2022 was to be long energy, and this sector gave early clues to that. Even back in September 2021, we can see here energy started outperforming, separated from the market, and that outperformance held on for over a year. And same with REITs, which broke away from the market in February 2022, and its underperformance held on for the rest of the year as well. And we can see similar patterns every year, with sectors breaking away from the rest of the market, and it kind of helps to identify leading and lagging sectors, and these trends can persist for some time. And just double clicking on the indicator, got the S&P 500 chart above, and if I just draw on a vertical line when it bottomed on the 27th of October, double click back on the indicator, we can see most sectors didn't really move off that bottom, but tech and communications did and have been the outperformers since then, along with discretionary here in the yellow line. And so by default, the indicator shows 11 sectors. However, the cool thing is you can add it multiple times to your chart, like I've done here, and I've configured this sector analysis to the 6 different major factors in the market using the ETFs for growth, momentum, quality, value, low volatility, and dividend. And once again, it's good for an easy visualization of what factors are performing well, and we can see ever since that low in October, momentum has had the best performance, and lately we're seeing dividend stocks starting to catch up as well. But still a big difference between the 1 year performance between growth, the clear leader, and the more defensive stuff of low volatility and dividend. So it just helps you get an idea of what market we're in, identify trends, leading and lagging sectors, and it's up to your own imagination as to what symbols and tickers you add to it to perform the analysis that you want to perform. And so anybody who's purchased my all indicator package will get this indicator added to their TradingView account free of charge over the next 24 hours, just like you did with my other new indicator from last week, shareholder yield. And I've got 2 other new cool ones I'm going to show you tomorrow, quant factor scores. And on Thursday, I'll show you my 4th newest indicator, my portfolio monitor. which you can use to see how your portfolio is going. And if you don't already have my custom indicators for TradingView, then stay tuned because next week I'm doing an Easter week special, offering them all for a deep discount, one-time fee, with the option to get my course as well. So stay tuned for that because you don't want to miss out on that special offer. Just diving back into the daily review, we can just see the persistent momentum in this market with persistently low volatility. Got the VIX now under 14, and even the bump up in bond yields of late, along with the dollar and crude oil breaking out, hasn't upset the picture at all for growth stocks and equities just yet. Even though we've had a little bit of a pullback in momentum stocks, they're still holding above their 50-day VWAP, and some of these other hotter stocks are having a pullback as well. There's ARM, Supermicro Computer, falling after announcing they're going to sell 2 million shares to the market, and a bit of a pullback in these Bitcoin related stocks like MicroStrategy. Very volatile just in the last 3 days alone. It's had a 32% drawdown, but we've still got industrials performing well like General Electric, other hot stocks like DraftKings, CrowdStrike hanging in there, Vertiv, Wingstop, and Abercrombie and Fitch recovering after it had its pullback. And the Nasdaq and Russell 2000 still holding ground above the 50-day VWAP, showing markets are still technically in an uptrend. And so we had a bit of a key event this week, Nvidia's AI conference, in which they announced their latest AI chip and platform for developers to build upon called Blackwell. And they don't want to be just the picks and shovels of the AI boom. They want to become a platform company like Microsoft and Apple. They want to get closer to the consumer, and they're building things like chatbots as well to run natively on the computer. And so we should expect a slew of new products and services to come out of Nvidia over coming weeks and months, which should help to keep the market excited on the back of the new Blackwell chip called the GB200. Even as its latest chip, the H100, is still really hot. A lot of companies still trying to get their hands on it. And this new chip is really powerful. It can deploy a 27 trillion perimeter model, and that's much larger than even the biggest models such as GPT-4, which reportedly has 1.7 trillion perimeters, with many AI researchers believing bigger models with more perimeters and data could unlock new capabilities. They haven't revealed a cost for it yet, even at a H100 costs between 25 and 40,000. And so they're still head and shoulders above the competition, and that's how they're able to get away with these huge price tickets, even with some whole systems that costing as much as 200,000, giving them product profit margins above 90%, pretty much just printing money here. And that's why we've got these mind-blowing stats, like Nvidia's market cap is bigger than Diageo, UPS, Philip Morris, Nike, Shell, McDonald's, L'Oreal, Nestle, Costco, and LVMH combined. Even though these 10 companies collectively make almost 5 times as much profit as Nvidia. Nvidia's obviously growing a lot faster, definitely deserves a premium. Question is how much and for how long will they retain those huge growth rates and profit margins? And so like I show you on these daily videos, by some measures, the current tech rally doesn't look as frothy as the late 90s tech rally, but on some other measures, it does. With this one here, the top 10 mega cap tech stocks with their enterprise value as a percentage of GDP. And so basically enterprise value is market cap plus debt minus cash, kind of a common way to value stocks. And so in 2000, the cumulative enterprise value as a percentage of GDP of the top 10 tech stocks reached almost 30% of GDP. Whereas here we are now just coming back up to the crazy peak from late 21, above 50%. So while some people make the argument we're not in a bubble, still has a lot of room to run, I think we can all agree it's hard to make an argument that it's cheap or we're early or we're closer to the lows than not. And companies are taking advantage of this hype and sentiment for AI, with S&P 500 companies citing AI on Q4 earnings calls saw an average stock price increase of 28% in the past year. And the stock market referee is picking up on that, with the SEC penalizing investment firms for AI washing, with some saying they're the first regulated AI financial advisor, another one claiming to make AI smarter so it can predict which companies and trends are about to make it big and invest in them before everyone else. SEC is already handing out fines to these companies using such language that isn't materially backed up, and even some of the biggest companies are falling behind. That's why we've seen Apple underperform for a while now. They don't really have an AI product, which is kind of mind-blowing considering they've got more cash on their balance sheet than anybody else. They should have seen this coming years ago. They worked on a car for 10 years, which they had to pull out, and you'd think they would have already come up with their own LLM, large language model chatbot. However, they couldn't, so they threw in the towel and partnered up with Alphabet to use their AI chatbot Gemini to integrate into their iPhones. That was good news for Alphabet, which closed up by more than 4% on the news. However, Apple shares still lagging. And so Apple and Google have had a long-term relationship. Google pays Apple tens of billions of dollars a year to be the default search app on iPhones, and so they're just extending that relationship to AI chat, and which should likely benefit both of them. And even though that really helped Alphabet's stock price, it's It's had a strong bounce off these lows from earlier this month. Not so much with Apple, still trading below its 50-day VWAP here, just kind of hanging around. Market's really not too excited by this stock anymore. And there's a look at Nvidia on this AI conference. It's already had a huge run up going into it, just consolidating here below $900 a share. So the question of this video title is, are we in an AI bubble or not? Well, like all things stock market and investing, it's part science, part art, and value and perceptions are in the eye of the beholder. And just looking across the investment landscape, what 226 fund managers say on this issue is they're pretty much split, which is pretty much the case across the whole investment industry, I would say. Looking at a selection of 226 money managers with over $500 billion in assets under management, almost equally divided on whether we're facing an AI bubble, with 40% saying we are and 45% saying we're not. One thing they do have consensus on is 84% of them saying they expect interest rates to start to fall over the next year, and 2/3 saying they believe a recession is unlikely in the next 12 months. 62% expect a soft landing, only 11% expect a hard landing, with 42% of them pointing to US commercial real estate as the highest risk in the market, with higher inflation pointed to as the top tail risk. And so we have a bit of a changing bond market as we speak. World's second largest central bank, the BOJ, raises rates for the first time in many years, ending an era of negative interest rates, going from 0.1 negative rates to a range of 0 to 0.1 in its first rate increase since 2007. Also removed the target for the yield on the 10-year Japanese government bonds, what they called yield curve control. And so they're kind of just pulling back their artificial manipulation of their yields and kind of letting market forces come in a bit more, which they're likely worried and trying to get in front of a potential resurgence in inflation. And we've seen that with their economy pickup in wages. Stock market recently broke out to a new all-time high, first time in over 30 years. And that could be having a little knock-on effects on global bond yields. We've got US Treasury yields moving up, with the narrative of higher for longer taking more and more hold, pushing back the date in which we expect the first Fed rate cuts. And it wasn't just BOJ. We also saw the Swiss and other European countries go into negative interest rates, in which future generations may look back on as being crazy. You're actually paying a bank to take your money off you. Can't really stimulate a market more than that by actually charging people to hold their deposits on top of the third-party credit risk. And looking back over the last couple of 100 years, that was the first time ever we saw interest rates in some major economies go into negative and close to negative. Didn't even get that close in World War II. And so like I often say, you see symmetry in markets. What goes really high can come really low, and then we see cycles. But a lot of people have never lived through 10% interest rates, and I'd imagine over 95% of people would say would never get interest rates above 10% again. However, never say never, because those high interest rates came from high inflation, and we've got the highest inflation now that we've had since this period back here. There's still a big divergence on where rates and inflation is as well. And as resilient as stocks have been, if yields keep going up, stock market will eventually have to react to that. Be a good reason for a rug pull, with investor sentiment running near records, a lot of people loaded on longs. That could easily turn into a bigger correction if we keep seeing yields pushing higher. And so we'll get to find out a bit more about all that tomorrow. The Fed meeting, deciding the interest rate, widely expected to stay on hold, but we'll be looking towards their economic projections and language, see if Jay's still holding the line as a dove, or whether he's going to dial it back a bit more and become a bit more hawkish and push back on near-term rate cuts. We'll also be looking at all Fed members' projections on where they think rates will go in the dot plot, and if he's going to keep being a dove, and if he's going to keep being dovish, that's going to turn more and more into a hard sell, given we've seen inflation prints the last couple of months come in higher than expected. Not to mention we've got a big driver of inflation, oil, in a clear short-term uptrend now, with demand expectations increasing, along with supply expectations decreasing, on top of a more aggressive Ukraine actually attacking Russian assets now, trying to hurt their biggest source of revenue from selling oil, and what's likely to keep driving more conflict and tension over there. We've even got the world's largest oil company, state-owned Saudi Aramco, CEO saying energy transition is failing. The world should abandon their fantasy of phasing out oil, which is pretty laughable, because if he really believed that, then why would you sell shares of your company to investors around the world, taking Saudi Aramco public a couple of years ago? The truth is they're trying to deleverage from oil, sell out and diversify their wealth because they know that transition from oil is inevitable, even though it might still take another 20 or 30 years. It's already in secular decline. Not to mention we've got the cost of renewables already coming down to the cost of fossil fuels and starting to economically compete with them. So regardless of the environment, regardless if you believe in human-caused climate change, just on a cost-benefit analysis, as every year passes, it'll become cheaper to go with renewables. Not to mention the world's guaranteed to run out of oil one day anyway, and just like the name renewable energy, it's renewable, it doesn't run out. So it's an inevitability, and Saudi Aramco CEO, of course, is just trying to talk up his book. And there's a look at the Saudi Aramco stock since it launched onto the market in late 2019. Came in at $29. Here we are, 4.5 years later, $31. Hasn't been a great return for investors, but like I said, it's allowing the Saudis to offload their company to investors around the world. And there's oil starting to look a little constructive on the weekly chart. I think it's fair to say we've got a bit of a resistance zone just above where we're sitting now, around $84 a barrel. If we can take that out, put in a higher high, the next resistance we'll be looking at is around that $95 a level, and that will upset a lot of things greatly if we take that out. And just moving on to Bitcoin, had a bit of volatility in it lately, pulling back quite a bit, and it isn't really talked about much by mainstream media, but most people don't realize how illiquid Bitcoin really is, even though it's been ripping higher as people pile on top of one another. When the time comes to hit the exit all at once, there's simply going to be no buyers, and this is going to be exacerbated by all the people that have piled into the ETFs and companies like MicroStrategy, which systematically sell debt to buy more and more Bitcoin, essentially levering up the whole market. We saw one trader on the popular exchange BitMEX offload 400 Bitcoin, not a huge amount relatively speaking, a bit over 50 million, actually causing it to flash crash down to 8,900 from where we've recently been just below 70,000 a coin. And I can see that on my chart in TradingView as well. That candle yesterday, and going down to a 15-minute chart, there it is there. There's all the volume. Over a period of a couple hours, the price was at 67,000. Then he offloaded a lot, got out. Price spiked down before it recovered. And that begs a few questions. Why was this person so desperate to get out? Look at the huge amount of slippage they had to eat just to get out of those 400 Bitcoins. And so apparently the world's future currency can flash crash 87% in a couple of hours just on 400 Bitcoin. Is this a preview of what the whole market's going to look like when we get some mass exodus event and see the mother of all crashes just because there's no liquidity? Because if it's crashing, someone has to step in and buy all this Bitcoin from all the ETFs and everyone else being margin called. Maybe MicroStrategy gets margin called and the whole thing comes tumbling down. There's definitely a risk, and this is kind of like a canary in the coal mine if you ask me. You won't see any other stable asset have a crazy price spike and slippage like this. You won't see gold do that. You won't see Microsoft do that. You won't even see the hot Nvidia flash crash like that in just a matter of hours, down 80%. That's crazy stuff. So I'd say that's what spooked the market a little bit here. Trading down almost 6% today, currently at 63,000 a coin as I speak. Still looks to be holding its uptrend above the 50-day VWAP, but that could be also causing that bit of a pullback in MicroStrategy. If I was an investor in this, I would be really worried about that price action over on BitMEX. And like I said a couple of days ago, a way to play this is by being long the BlackRock Bitcoin Trust IBIT, short MicroStrategy, but it is a highly risky trade. However, if we see Bitcoin crash, I imagine MicroStrategy is going to crash 2 or 3 times as hard. And just moving on, there's a look at Fed Fund Futures probability as we go into the Fed meeting tomorrow. 99% chance they stay on hold. No surprise there. 96% chance they stay on hold when they meet again on the 1st of May. And about a 63% chance they cut in June. This is the big one that could swing tomorrow depending on what Jay Powell says, along with the Fed's dot plot. Market currently pricing in 3 rate cuts this year. No surprise, the Fear and Greed Index still in the high end of greed at 71. And a little bit of a surprise yesterday, we saw some corporate insiders doing a bit of buying here. The most they've done in a few months, 123 purchases versus 208 sales, closing that big Jaws gap we had for a few weeks there. As a look at the 10-year yield, we'll be watching this zone tomorrow, see if we can break out above that 434, which is also a bit of a support zone on the TLT. High yield bonds hanging in there. Ethereum not looking too good, sitting right at its 50-day VWAP. A little bit of a pullback in shipping rates, still on an uptrend. Gold consolidating, just as it comes off all-time highs. China consolidating. Clean energy trying to find support, it's looking a little technically oversold. International stock indices all had a good Tuesday session, finishing higher. Got a nice pop-up in cannabis yesterday. After I did a special on it on Friday, we finished up 6.6%. Pulled back a bit here today, but still holding ground above the 50-day VWAP. Hoping to hear rescheduling from the DEA any day now. Got a strong rip in ExxonMobil, walking the line here. The back of crude ripping higher. I can see momentum coming back in the market on my trend strength indicator. And like I can see in my sector analysis indicator, the black line, energy, climbing steeper more than every other sector. Over this last week, we can see some of these other growth sectors, tech, communications, discretionary, all kind of pulling back a bit, but energy, financials, and industrials a little bit, popping up a bit. As a look at the latest meme stock, Root, a technology insurance company, market cap 679 million, been on a huge tear this last month, $13 up to $60 yesterday, huge pullback today, down 21%. Other hot stocks, SoundHound AI. Nvidia invested in this. $2.5 billion market cap, even though they only got quarterly revenue. That's 17 million. Tiny business, market's in love with it. But other meme stocks getting a bit volatile, selling off a bit here today. And we've got some pretty good price action in the aerospace defense stocks, moving up a little bit higher, with some breaking out as well. And the banks holding ground. JP Morgan sitting at all-time highs. Alright guys, there we have it for today. The grind higher continues. Make sure you come back to the channel tomorrow and we'll dive in to all the language and commentary we get out of the Fed and what effect that's having across financial market. Thanks very much for tuning in and clicking that like button. See you all again tomorrow. Cheers.